Good morning, everyone. Today we have a results update on global logistic properties and initiation on Apple. So first up, GLP. Um, there's softening demand in China. So they reported results last Thursday. So revenue came in 19% higher, 199.1 million USD. And the higher revenue was driven by more completion and stabilization of projects in China, as well as the inclusion of management fees that were included for two tranches of US properties. And these properties came from GLP US Income Partners 1 and 2. So in the bottom line, it grew 46% mainly because of higher fair value gains in the China assets. And on a full year basis, revenue growth is pretty much driven by the same set of reasons. But on the bottom line, there was also higher fair value gains on top of gains from China assets. So this includes higher gains from revaluation of the investment properties under its joint ventures in Japan and Brazil. Overall operating performance came in stronger than expected, but going forward, we should expect some moderation, which I'll get into in the next slide. So rental rates across GLP's portfolio, it grew across the board except for China, where it maintained at the current pace of like around $1.09 RMB per square meters per day. And China is extremely important for GLP because of the weight that it has in its portfolio. So as of March 2016, 57.6% of net asset value comes from China alone. So it's essentially too big to ignore it. Now, on the lease ratios in China, it dipped across the board. Sorry, I mean lease ratios across its portfolio, it dipped across the board except for Japan, where it's still coming strong at 99%. And Japan represents 20.9% of GLP's rental income. On its portfolio, lease ratio is down to 92%, and this is 1 percentage points lower compared to a year ago. Next, again, still in China, we expect further rent pressure and higher vacancies in the weaker markets in China. And the main reason behind this is because of the oversupply conditions on the ground. So for 2017, management intends to focus on locations with strong demand and limited land supply. So where are they referring to? They're referring to these stronger markets in China. So can I just bring everyone's attention to this diagram at the bottom? By classifying the way to understand this is the stronger markets are places where the average lease ratio remains high, as well as the absorption rate here. So both of these factors denote the demand on the ground. So stronger markets are places like in the first-tier cities such as Shanghai, Shenzhen, Guangzhou, and Beijing. So you look at this, absorption rate is more than 100%, meaning that demand is still extremely strong on the ground. And this is exactly where the management wants to focus in 2017. And then if you look at the left part of the chart, the weaker markets are essentially in places like Tianjin and Chengdu. And why are they weaker is because of the oversupply conditions on the ground. And having said that, we expect further moderation in the China portfolio, where we think that lease ratio would most likely, within the next few quarters, it may see further moderation, or at least there will be some rent pressures in the near term. So more importantly, I'll point out to everyone that there's a significant portion of leases that will be expired this year. Around 29% of it is up for renewal. And judging for the current market conditions in China, it's going to be a challenge for them to get good rental reversions going forward. And having said all this, the management expects higher vacancies and rent pressures in the weaker markets in the near term, and they will focus on new developments at the locations with strong demand and limited land supply, which they are referring to these stronger markets. And finally, still in China, demand for space in these in their key markets. Wrong, sorry. I mean, on a portfolio basis, demand for space in key markets are expected to falter. And because of this, management intends to focus on boosting portfolio occupancy rates instead. So by now, we probably understand that there's a softening market conditions in China, and this has led the management to trim development start targets. In 2016, actual development starts came in at US $1.7 billion, and this year they've guided $1.4 billion, which is like 17.6% lower compared to last year. However, in the longer term, the management remains confident to deliver the 25% development margins or fair value creation margins. In 2016, or the latest financial year, it came in at 27%. So finally, having said all this, we have to say that they acknowledge that the weaker market conditions have led them to, instead of going aggressive towards doing more development starts, they are looking inwards by trying to boost operating performance, like looking inwards to boost lease ratio and such. Why is this important? Because this is the 4th quarter since the occupancy rates has been falling. So it makes sense for them to look inwards to start boosting their, to boost efforts in order to boost their operating performance. Then having said so, we did a downward adjustment to our estimates, and more importantly, RNAV per share with our full year RNAV per share has, even though it went up, but we've applied a 15% discount to RNAV to take into account of the burgeoning market conditions. So having said that, our target price is $2.28. And there are some other information out there which you can go through yourself, and if you like to.
Okay, this is Kang Wei here. We're going to do a short presentation on our initiation on Apple, which we released, I think, the report about a week and a half ago. So just a snapshot of the company. So you can see that the last close on Friday was $95.22. Our target price for is at initiation is $119.37. You can see that over the past 1 week since we've released the report, Apple has actually recovered somewhat, about 3 to 4%. I think most notably over the past week was news that Warren Buffett had actually bought about $1 billion worth of shares from Apple. In the grand scheme of things, you can see that market cap wise, $1 billion is not really anything substantial to Apple, and definitely not anything substantial to Buffett himself. But of note is the fact that Buffett usually steers away from this kind of shares, this kind of companies, and it's probably quite noteworthy that he feels that Apple is so undervalued that he was actually willing to approach the technology sector. So this is the investment thesis or merits that we feel Apple has that merits investment in them. They have a strong brand equity with a large loyal base. They're transitioning to a service company. The rising consumer affluence in developing markets, strong balance sheet, and an attractive capital return program. So let's talk about why Apple is down. Since you can see from here, they reached this past year to date so far, they've been underperforming quite a bit. So mostly it's on fears of what people are calling the peak iPhone, or the idea that iPhone has reached saturation point and going forward would not be contributing. Apple has lost a bit of their growth and revenue generating power. You can see in the latest financial quarter that they reported that the iPhone revenue has actually dropped about close to 20%, same as the iPad revenue, and Mac revenue has dropped somewhat. Year on year, their revenue is actually down, and quarter on quarter down almost 33%. They missed their consensus estimate for revenue, about 1.37 billion, and their earnings per share missed by about 10 cents per share. Gross margin was also down 39.4% versus 40.8% year on year. But services were the saving grace for Apple, growing at close to 20% year on year. And Apple actually reported that their App Store revenue grew 35% year on year, and that their Apple Music actually managed to increase their paying subscriber base from 11 million to 13 million. Apple Pay, which also managed to increase its transaction volume by 5 times, despite being a very new service. The other products revenue also managed to increase, with Apple Watch sales helping to pull the other products by almost 30% year on year. As mentioned, the iPhone sales, unit sales were actually down 16% year on year, with iPad and Mac unit sales also down, pulling their share price down a lot. Besides the weak Q2 earnings results, Apple also guided down for their third quarter, with revenue projected at 41 to 43 billion, down about 15% year on year, and also lower than the consensus analyst estimates for their Q3 results. Gross margin was also projected to be down year on year, 1 to 2%. All in all, that led to Apple being beaten down quite somewhat over the past couple of weeks. But overall, we feel that there's still a very strong brand with a very strong loyal customer base. As you can see, primarily Apple's revenue comes from the iPhone, with iPad, Mac, and services more or less making up roughly close to about the same amount of revenue. The iPhone revenue last year was actually had a phenomenal year-on-year sales growth of about 40%, and unit sales actually increased at a CAGR of about 17% year-on-year over the past 4 years. You can see that. Unfortunately, they had poor results in the latest quarter due to macro headwinds, but we view it more of a normalization in terms of their growth instead of a decline. And this is likely to be the first year Apple will actually report a decline in the unit sales of iPhone, again leading to the, we feel, overblown fears of peak iPhone. Now, the mitigating factors of this decline in the iPhone sales is Tim Cook has mentioned a Kantar survey, which indicates that iPhones actually have a 95% loyalty rate. iPhone 6 and 6 Plus account for only 24% of all iPhones used in the USA and China. And Tim Cook estimates that about 60% of all current iPhone users have yet to upgrade to a 6 and 6S and above, meaning that there's actually 60% of users who are using a 5S and below, meaning there's actually a large pool of loyal potential customers ready to buy the next iPhone offering. Besides that, Apple also mentioned that in this first half of the FY16, they've actually had more switches from other OS to the iOS compared to any other 6 months period ever. And besides that, they also have a large pool of potential first-time iPhone buyers. For example, they cited the Indian market, which had sales growing up to 56% year-on-year. So there's actually a large pool of first-time iPhone buyers in developing markets as well. Besides that, they had the new release of the iPhone SE, which released on 31st March, so actually not included in the 2Q FY16 results. And they cited that demand has already exceeded the estimated supply. So that indicates there's actually a pent-up demand for cheaper iPhones, which, it follows in our thesis that in developing countries there's actually great potential for more future iPhone buyers. If Apple follows the same releasing schedule, likely in September this year, the iPhone 7 will release. And if they, unfortunately, that will not be within this financial year for Apple, but could have potentially good results for the next financial year. And as mentioned, there's a large pool of older iPhone users yet to upgrade, so that could be quite a large uptake rate for the iPhone 7. So overall, there will likely be headwinds to continue in the increasingly saturated developed nation smartphone market, but the developing nations look like a good growth opportunity for the iPhone. So we feel that overall they still have potential to grow, but it is likely to be at a slower rate as compared to what is seen over the past couple of years. I'll just slightly touch on the iPad because we feel that overall over time iPad will account for less and less of Apple's revenue over time. The iPad sales had fallen 19% year on year, but their unit sales actually performed better than consensus estimate. The new iPad was released at the end of 2Q FY16, so the full effect has not yet been captured. But tablets tend to have a longer replacement cycle compared to iPhones. You know, people are less compelled to upgrade their tablets every year or every product cycle. So we feel that over time it is less likely to iPads will probably contribute less and less to Apple's revenue. MacBooks have been on an uptrend for the past 3 years, but sales fell 9% year on year in 2Q FY16. A mitigating factor though is that 80% of Mac buyers in China were actually purchasing for the first time. And Apple expects Mac sales to increase in the next quarter because they're going to update their MacBook with a thinner, lighter, with updated specs. As MacBook seems to be gaining more traction as a PC and laptop replacement, especially among the younger people, we feel that MacBook sales will continue to increase and may account for a larger portion of revenue for Apple in the future. Of note, in the other product segment, Apple Watch actually led to a 30% year-on-year growth in the Apple other product revenue segment. This is a relatively new offering, and before that, there was no Apple Watch. So it remains to be seen whether this take-up rate can continue to be sustained, or whether it will become like maybe the iPad, where slower replacement cycles will lead to lower growth in the other product segment overall. But in the meantime, it seems to be quite promising. Now, Apple is currently primarily valued as a hardware company. If you can see back into our first table here, you can see that services doesn't really account for much of Apple's overall revenue. But the thing is that they've actually been growing, taking large steps into transition as a service company. Their service revenue actually grown 20% into US 6 billion in this recent quarter. And in the previous quarter, they reported that they had 1 billion active users, and that the this user base actually contributed to a 27% year-on-year growth in related purchases. The App Store actually grew revenue by 35% year-on-year and generated 90% more revenue than Google Play. Apple Music also had an increase in paying subscribers from 10 million to 13 million in 2 months. Apple Music was actually launched only in 30th June 2015, so it's actually been less than a year, and they've already have impressive growth rate to 13 million paying subscribers. And Apple Pay was recently launched as well in Singapore, and you can see that the transaction volume is up 500% since then. Apple Pay doesn't actually contribute anything of note to the revenue as of now, but it's still a technology that's in its infancy. And if they manage to continue to grow at this impressive growth rate, Apple might eventually be able to monetize this service as more people start to move towards using their smartphones to pay for things. So we do see that there is great potential in the Apple as a service. Apple has been able to, you can see from the table, the chart below, achieve consecutive double-digit growth, averaging 20% over the past 5 years. Quite impressive growth rate. Services will also provide recurring revenue streams independent of hardware sales. So as the thesis that your hardware sales continue to slow down, with the growth of services, it would not matter as much even if Apple users start to replace their products every maybe 2 product cycles rather than every product cycle. And with the increased services, you also help entrench users into the ecosystem for Apple, creating more stickiness in the product. So you also, as you partake more in Apple services, maybe users may be encouraged to buy, more tablets, more MacBooks, and maybe just surround themselves with Apple products instead of just using the iPhone alone. Third investment merit is the developing nations. You can see that this is the breakdown in FY15 of geographic breakdown. You can see that America still accounted for 40% of Apple revenue, but the growth is slowing in the Americas, where they grew in 17% in FY15, where the total revenue grew by 28%. China was the one that accounted for 25% of Apple revenue and grew at an incredible growth rate year on year for FY15 at 84%. So it is, you can see that they have really had an incredible growth rate for the past year. So when we say that they had a slowdown in the recent quarter-on-quarter slowdown of 32% and year-on-year down 26%, while noteworthy, we do think that this is less of a problem and more of a normalization of the growth rate in China rather than just oh my God, they're not selling as much iPhones anymore. So, to put things in perspective, you can see that the year-to-date revenue from China is at $30.8 billion, whereas FY's 14 total revenue from China was 31.8 billion. So, year-to-date and the year and financial year is not even up yet. They've already, collected almost the entire FY14 total revenue from China. So yes, slowdown is a worrying thing, but put in perspective, they are earning, in half a year already as much as they earn from the total FY14 year from China. Besides that, you can see APEX ex-Japan only accounted for 6%, APEX ex-Japan, only 6% of FY15 total revenue. Of note inside there is India, which sales grew 56% year on year. And as a lot of these developing countries continue to have an increased rollout in their LTE networks, which is more effective than your 2.5G or your 3G, that could lead to increased demand for higher end smartphones. Because if you are on a worse network, then there's not much point in getting a very high end smartphone. You are probably able to make do with a lower end smartphone. APEC ex-Japan accounted for only US 15 billion in terms of revenue, again 6% only, whereas it's still home to a lot of developing nations and a large population base. You have Indonesia and India, two of which are in the top 5 most populous countries in the world, and yet they only account for 6% of Apple's total revenue. So there's actually a very large potential for growth in these in these segments. So besides that, Apple also has a very strong balance sheet. Apple famously has a very large cash hoard. They reported in the recent quarter that they have $232 billion in cash and marketable securities, both short and long term, which is up 20 billion year on year. Of note, 90% of this is held overseas due to US tax laws. If they were to bring back the money from their overseas back to the US, they will actually be liable for upwards of $60 billion in taxes. So Apple has chosen to keep these monies overseas while they instead take advantage of low interest rates in the USA to take on more debt to finance both R&D as well as acquisitions, as well as the capital return program. So they actually issued 15.5 billion in USD notes in the latest quarter, and their total debt now stands at 72 billion. So that puts their net cash position at about 160 billion USD. So if you divide by the number of outstanding shares, that's equivalent to about $30 per share, which means every time you buy an Apple share, essentially you are entitled to US $30 per share. Apple has increased their dividends to 57 cents per quarter, which is up 10% from the previous, which is 52 cents per quarter. This represents the 4th consecutive increase year on year in 4 years since Apple started paying a dividend, meaning that for every year since Apple has started paying a dividend, they have actually managed to increase that dividend at a cumulative annual growth rate of about 8% per annum. And this latest payout ratio is only about 24%, which means that Apple actually has a very large, has a lot more room for growth in that dividend policy. They've also managed to increase the buyback program by US $35 billion. So now it's from 140 billion to 175 billion, of which about 117 billion has been used so far. meaning there's still roughly about $60 billion worth of buyback, which Apple is committed to finishing that purchase in by I think end 2018. So, 60 billion is more than 10% of their current market cap so far. So that's how much more to give in relative terms they have to spend. And since September 2013, the share count has actually managed to reduce from 6.3 billion to 5.5 billion. So they've actually managed to reduce that share count by almost 1 billion shares. So we used a discounted free cash flow model when we used to derive the valuation for Apple's intrinsic value. These are some of the assumptions for the model. We believe that headwinds in iPhone sales will continue to decline, lead to decline and slow growth for the next 2 years. After which we project for iPhone sales to continue growing but at a slower rate. Due to we believe that the iPhone 7 and above will continue to have a good take-up rate. iPad sales, we believe, will pick up in the next financial year, but will repeat the cycle of slow replacement, and essentially will be a flat revenue growth for iPad sales. We project that the MacBook will continue to increase as MacBooks gain traction and more mainstream acceptance as PC and laptop replacements. And that service revenue will continue to grow as they expand their ecosystem and continue to increase the monetization of that installed user base. So with that, we project a price of about 119.37. You can take a look at that for a while. Okay, moving on. These are the following risks or valuations. The key risks might be possibly the poor response to iPhone 7. So as mentioned earlier, Apple does have a very loyal customer base, but if the iPhone 7 were to have a lackluster showing, it could lead to even longer replacement cycles, people choosing to keep their iPhones for longer and not choose to upgrade them, which might lead to slower replacement cycles in the future. Weakened consumer sentiment amidst global slowdown. Global slowdown in the economy could also negatively impact iPhone take-up, which all in all will adversely affect the valuation for Apple. So we'll continue to keep an eye out for that in the next few quarters. Besides that, also the slowdown in services, as we project that Apple is trying to transition to a more service company rather than purely hardware. If the service revenue were to slow down, or if the installed user base fails to be able to monetize properly, then that also could affect the valuation for Apple. So these are the two things that we feel we want to keep an eye out in the next few quarters to see if Apple can continue to sustain the growth rate for services, as well as they are able to at least maintain or reverse the decline in iPhone sales. So in terms of US listed companies, it's not easy to find a very pure comparison, because for a lot of the Apple competitors, they also dabble in other things that Apple doesn't do, and Apple also does things that a lot of them don't do. So we've chosen Google, which is Alphabet, as well as Microsoft as the peer comparisons for US listed market, the US listed shares. Apple remains the largest of the three companies that have been chosen, as you can see this table here. But in terms of PE ratio, they've actually the most undervalued of the three. And if you were to compare in terms of to their historical PE ratio, Apple is also trading at their 8-year low valuations at about 10 point something PER versus your 5-year average about 13 point something PER. So in conclusion, we would like to initiate a buy rating with a target price of US $119.37. Just to recap, Apple gave poor guidance for the next quarter, along with weak results in their most recent quarter that caused the Apple share price to tumble down. And we feel that Apple's share price will likely remain depressed in the short term on fears of iPhone saturation. But overall, the strong balance sheet with net cash of about $160 billion. So that indicates actually a net price of actually about close to US $60 billion, US $60 per share. Because if you take into account the fact that for about $90 share price, you're getting about $30 $30 US in terms of cash. Strong brand loyalty allows Apple to continue to generate large profits and cash flow even in this difficult season of slowing iPhone growth. This growing service revenue is promising, and right now multi-year low valuations suggest that maybe Apple is undervalued at the moment, and at our target price that represents close to about 28% upside to our target price. With that, we've come to the end of our presentations. Are there any questions? Okay, since there's no questions, we shall end the webinar here. Thank you, and see you guys next week.